I'll quickly introduce my partner, Itai. Itai is an incredible former hedge fund manager. He's had an exit on that end. He is a student of markets, built a $100 million wealth management firm. He is the sharpest guy that I know on this end. He is my partner here at Equilibrium Ventures, and he is usually the person that's walking us through our content. So say hello to Itai.
That was well too kind. Thank you so much for that, which is a humbling experience. So thank you for that. On Jeremy's end, he's also done not too shabby for himself. So 500 million lifetime in sales for your last. Actually, that was 2 exits ago. Another exit that sold to Coinbase, and bringing all our technology and ability here. So I wouldn't be able to do that without you either.
Yeah, well, somebody's also got to be a pretty face somewhere, because you sometimes can look haunting. No, I'm just kidding. You're a handsome guy, and we all know that. So, anyways, Itai, I know you've got quite an agenda for us today. Could you just quickly let them know maybe what they might hear about, and then I'll add you as the I'm going to add you as the host.
Yeah, so I just want to cover everything from COVID to current economic conditions. To kind of everything that's going around that we've seen. If we had time, we'll go a little bit into options, but something tells me that we probably won't, because there is kind of a lot to cover. I looked at research from various investment banks, news sources, and kind of funneled what I think is important to give you guys a little bit of perspective into what we may or may not see that you don't necessarily hear about.
That sounds awesome, man. I'm excited to get educated today. It's been a while.
All right. So without further ado, let us hop right into it. All right. Everybody sees the PowerPoint?
Yeah, I see the PowerPoint, but it's right now, it's that view where you see all the different slides. All right, perfect.
All right, so market overview, July 2020. Just a little brief about us. We're Equilibrium Ventures. We're an Austin-based investment advisory firm. We specialize in uncorrelated strategies, creating growth in a low volatility way by using various diversifiers, and we have a very unique asset allocation that you would find versus other managers. If you wanted to hear about it, only if, you can contact either me or Jeremy later on.
Yeah, and that's for you or anybody else that you think would benefit from it.
All right. First, let's start with COVID, because that's been dominating the news. And today, the news of the day was, I believe the market was up maybe 1.5% or something like that when the news hit that California is reclosing everything, bars, restaurants, barbershops, and basically going almost full back to a lockdown. The market clearly did not like that one bit. So let's talk about COVID and see where that looks like. And again, I'm not a doctor. I'm not a virologist. So I'm just looking at the data that I see in there. And if anybody has anything to contribute, I would welcome that. So first of all, let's start with the new cases. We are seeing that cases are exploding, generally in the US right now. But when you're looking at deaths, and this is as of today as well, deaths seems to be pretty much getting milder. In the beginning of the pandemic, around April, we were between 2 and almost 3,000 a day, and now it's actually a couple hundred as of the last reading. So I've heard a couple of theories on this. The first one is the deaths is going to increase at some point once there's a lag time between cases and deaths. But if you're looking at cases increasing, they've already started picking up around June 20th. And so far, we have not seen a corresponding pickup in deaths. So I think the market will really be looking for the next couple of weeks to see if the death spike versus just cases. Because if that's the case, maybe that would really lead to more lockdowns. So I don't know if it's I've heard of theories that it could be a weaker strain that's going on now, or the deadliness of the virus has subsided somewhat. Whichever the case, I think it's going to be a lot more important to look at the number of deaths going forward versus than just pure cases. Um, Continuing onwards. So I read this really interesting Deutsche Bank article over the weekend that says that a lot of the initial response to COVID that was going on was actually happening because what they believed at the beginning is that COVID's distribution was similar to the 1918 flu. What I mean by that is, in the beginning of the pandemic, there was this paper that showed that cities and areas that had quarantine in 1918 fared pretty well in the medium and long term versus cities that didn't. And as a result of that, that was a lot of what was leading policymaking decisions at the time. So given that the distribution of 1918 and the distribution of COVID as far as death goes are very, very different. You can see in dark blue, that's 1918, and in light blue, that's COVID. So the 1918 pandemic really hit the very young and the very old, but it was more like a U shape. But it also had a pretty significant impact of the working age population, which is potentially why that worked. However, COVID is almost completely catered towards the older, where 85 and over, and even 75 to 84 is fairly similar to the Spanish flu, but the other ones is not. So a lot of the early response was pretty much because of that, and that may not have necessarily been right. This is another from that Deutsche Bank research. This is just counting deaths by age, excess deaths, so deaths that are directly related to COVID. You can really see that under the age of 44, there's really been almost no excess death to COVID. 45 to 64, you see a little bit, and it really skews over in that area. So,
and Itai, just because some people end up dialing in, maybe just hit on some of the numbers as you're doing this too, just so that they can kind of hear, because not everybody's going to be able to see it.
Right, absolutely. So, ages 0 to 44 is basically negligible increases in deaths, and then around 5,700, 45 to 64 climbs to almost 8,000, 65 to 74. Then it goes exponentially, 18,000 to the 75 and over, and 26,000 to the 85 and over. So most COVID deaths have really been confined to the elderly.
Got it.
So also we hear a lot about Florida. I actually wanted to look at recent data myself, and you can see the new cases of residents by day have increased quite a bit. So on June 25th, for example, we're talking about 10,000 cases per day. I believe yesterday was 15,000 a day. So that's a 50% increase. And today I think we're about 12 or 13,000. So that's still much more than we had before. But again, deaths, we've actually seen new lows today, which I don't remember. I didn't hear much news about that at all. I also wanted to look and see how much testing was taking place. And here's the testing that's taking place in Florida. So we can see on June 29th, for example, there were only 36,000 tests. 17% tested positive, which is 7,372 out of those. But that has increased significantly. Out of, for example, on July 10th, we had 73,000 tests, and we've tested 15% positive. So if you go back here, I'm not necessarily sure that we really have an increase in cases, or we're simply testing so many more people. And as a result of that, we're seeing an increase in cases, because the death toll doesn't necessarily reflect that. So it makes me wonder if the entire data reflecting significantly more cases is just a result of better and more significant testing. And I think that's an open-ended question.
Well, if you were to 3x the number of, if you go forward one more slide, if you 3x'd the number of cases from 629, what would that put us? That would put us at about, what, 21,000 number of positives, which looks in line with what it was on 7/11, right? Because I would say that we've probably about 3 or 4x the number of tests over the course of the past 2 weeks in Florida.
And that is exactly what I've been noticing. So, then that means that potentially, going back to quarantine could be excessive. I don't know the exact situation in California because I didn't analyze it. But I think that's one of the reasons the market is not overly concerned about this at the moment. But I think it's a developing thing right now. But I do see positive signs with the way this is unfolding based on number of tasks and death versus cases. And I think the next 2 weeks are going to be really, really critical to see if the deaths actually spike up or not.
Got it. Cool.
All right. So that was COVID. Now let's talk about earnings. So we all know earnings have been significantly impacted from COVID. So this one is from Goldman. The bottom-up consensus is right now for a 44% collapse in Q2 earnings. Goldman actually is much more bearish, estimating a 60% collapse in earnings, which obviously is going to make P ratios much more expensive given the rally in the markets, right? And then somewhat of a recovery into Q3 and Q4, still lower than the next year. And if we're looking at it on a year-by-year basis, their baseline at sometime in 2021, we will resume the same level of earnings as 2020 pre-COVID. The downside scenario is it's going to take until 2024. So, you know, the market is forward-looking. So I think this is kind of interesting what their take on that is. But earnings are definitely going to not look good. And earnings season, I believe, is starting tomorrow.
When you say earnings season, that means that the first announcements are coming through?
Yeah, I think the banks are going to start reporting first, and we'll see how much money they lost. And you know, it's all going to be about the forward guidance. The numbers we all know are going to look terrible. So what the market's going to be looking for is the guidance going forward and what they're seeing on there. And then I think, you know, when that comes out, that's going to be really interesting.
Which sector are you most curious to see earnings for, and why?
I think the financials, the banks. So I want to see how all the potential defaults, forbearance, and all these things that are going on are impacting lending and their bottom line, because at the end of the day, everything is driven by the banking system. So, you know, if the banking system is still relatively healthy, if you have some defaults in leisure and hospitality, that's not a big deal. But usually you get a global financial crisis when you have problems in the banking system.
That makes sense. How about everybody in the audience? Any questions?
I'd highly recommend people read the tweet thread that I shared. The first one is more relevant to people everywhere, like both outside the Bay Area or inside the Bay Area. The second one is probably a bit more Bay Area specific, but still pretty useful.
Got it. Do you want to give somebody a quick teaser sentence of what they're going to learn or see in it?
Yeah, it's two of who I think have emerged as like the most respected voices around what's actually happening with COVID, and as well as I think a pretty thorough, probably one of the best like scenario analysis that I've read so far anywhere for that first thread.
Cool. So if people end up hating it, they can complain directly to you?
Yeah, feel free to.
Awesome. Cheers. Thank you, Tori.
I had a question.
All right. Yeah.
Itai, how much of so you mentioned how everyone knows it's going to underperform, Q2 earnings are likely to underperform, but you know what people are really going to be looking for is the guidance. How much of the sort of downside scenarios on guidance do you think are already priced into the market? And sorry, it's a two-part question. And given the Fed activity, the kind of unlimited QE, you know, even if it's terrible, will that still not really affect the market?
Yeah, I think that's what everybody wants to know. That's why I'm going to be watching those earnings like a hawk, because I think we're going to find out a lot about how stable the market is when the market digests in the next 2 weeks. The earnings and also the death ratio. I think the market's watching deaths a lot more than they do cases right now, for the reasons we talked about. All right, let's go a little bit forward. All right, so there are some, we talked a little bit about the negative on the on the earnings front, but there are some signs of significant labor market recovery. We'll talk a little bit about that. So first of all, non-farm payroll, we lost, I think, what was it, 20 million jobs, and then we have recovered in the last 2 months. The June payroll numbers came in, I think it's around 5 million. I can't see the exact here. But that was quite a recovery that nobody was expecting. I mean, the labor market came in fairly strong. And those are lagging indicators. I want to look at some forward indicators for the labor market. So first of all, the initial claims have dropped substantially. Is where they are right now. And also, when people are asked, is it hard or easy to get a job? That's normally has been correlated with the initial unemployment claim. And that's come down quite a bit too. So I think a big reason of that is this, which is one of the things that I like as a forward indicator. The percentage of firms with one or more job openings. You see where it went in the trough here in COVID. We lost years worth of progress, but it's recovered quite a bit, which is interesting given everything that's going on, that there is still, the number of firms with job openings is actually increasing. And also, when firms are asked, are you expecting to increase employment or not? That number went down from COVID from a very hot economy. We went almost to zero right there.
So we started, just for everybody else who's on there, we started about 20%. We dropped to almost 0% of firms expecting to increase employment. Now we're back almost at about 16%.
Right. So not everything is bad. I mean, the labor market is showing some significant resiliency. Maybe because people have learned to work remote. They're seeing productivity is still going on. I'm not entirely sure the reason, but I am seeing some sign of recovery in the labor market. But it's, of course, the labor market is comprised out of many different sections. So the Challenger report kind of cuts that into what's going on. That's total job cuts. So obviously that's kind of a big number, but what's impacted, what's not impacted. Services, including the e-commerce, et cetera, not impacted. Oh, I'm sorry. Retail and entertainment and leisure, that's obviously the biggest impact here. Manufacturing of durables, impacted, but not worse than prior recessions. What's interesting here is financial, insurance, and real estate might as well if COVID didn't even happen. If you work in one of those industries, you didn't even necessarily feel COVID going on. Manufacturing, non-durable, some impact. Telecom and utilities, very little impact as well. So, this could obviously contribute to the income disparity and all the things we're currently seeing, but the service economy in the labor market is relatively unscathed by COVID so far. Now, it's also regional.
Do you ever see anything on elasticity on jobs? Meaning, like a guy retires, manager moves to vice president, worker moves to manager, new hire. Do you have anything on? Have you ever seen anything on the elasticity on the job market?
I know there's I've heard about it, but I'm not as knowledgeable to comment on that.
Well, Jeremy bet me $2 if I could stump you tonight, so he owes me money.
You got Venmo? I'll send you
I'll
mail you a $2 bill, okay?
Elasticity of supply and demand. That's definitely a macroeconomic term. So sorry about that.
Yeah, no worries. Yeah, tell us about this regional employment.
Right. So it's not only that we're seeing the job market being fragmented on what industry you're in, it's also very regional specific, and the recovery from COVID has been very regional specific. So Chicago, for example, was already experienced some kind of employment trouble before COVID even hit. That's 2019 right there, and it's already going to this level, and it's seen as of the June numbers, absolutely no recovery whatsoever. Philadelphia has seen some kind of bounce. Richmond Fed has seen some kind of bounce. Kansas City has seen some kind of bounce, and Dallas actually didn't even go nearly as low as '08, unlike other areas. And it's actually almost at the zero line from a relatively better location.
But this is not the specific cities, right? This is a larger area.
Yeah, correct. So if you're familiar with the Federal Reserve System, this is measured by a Fed area. So the Fed has divided the country into 12, which each one is controlled by a Fed district. So we know, for example, when we're looking at the Dallas Fed, it actually represents this entire area under 11. But I think what is interesting for real estate people out there, and you're looking at migration trends, if you're looking at the employment recovery from COVID, what cities are recovering, what areas are recovering faster, and what areas are recovering slower, that's probably going to contribute to trends of population shift within the country and within those areas.
So that makes sense. It's like if you're in that Great Lakes region, like you're out.
Yeah, and I think we've seen a lot of that with recent U-Haul data that we're looking at, and all those kind of things that we're seeing significant price disparities. Like I was reading the other week that it takes you 3 weeks to rent a U-Haul to be able to get out of Chicago right now.
Yeah, that number will probably just grow. Unfortunately, we love Chicago here. Okay, softs. There's a place in my heart for it. Okay.
Right, but if you're looking at the really the areas that are suited better for recovery so far, they've been 10, 11, and 5.
So we have the East Coast, like really what this like Denver, the western part of the Midwest, and Texas.
Right. It's not really the East Coast. It's more like the Virginias
Carolinas.
And Carolinas. Yeah.
Yeah, that makes sense.
Okay. Next on, I wanted to cover volatility a little bit and talk a little bit about the difference between realized and implied volatility. So
could you have chosen a more confusing graph, by the way? There is so much stuff happening on this slide.
I apologize. I thought it was fascinating.
I'm giving you a hard time, man.
I thought it was fascinating, this slide.
Well, what's important on this one?
Okay. So first to understand, there's two different measurements of volatility. There's implied volatility, which is what the options market or the VIX tells you volatility going forward is going to look like. And there's realized volatility of what volatility actually has been. And normally, implied volatility or options volatility overstates real volatility by quite some time, which is why option sellers usually make money most of the time until they get wiped out every once in a while. So we can see, like, for example, this year, the VIX has hit, I think, 80, but real volatility never exceeded 46.3. But the whole idea here is this year has been, as far as daily movements of the S&P 500, the most volatile year since the Great Depression of 1932. And we've seen some really, really, really crazy moves. It's been more volatile on a day-to-day basis so far since than the financial crisis, or 2001, or 1987. And what's interesting about volatility too is that it's mean reverting, and it always has been. Periods of low volatility have been replaced by periods of high volatility, back and forth to low volatility. What is interesting though is that since 2000, or even the late 90s, we have been living in a more volatile world than 1940 through almost 1990.
Why do you think that is?
Well, we've covered demographics. We've covered a lot of other reasons. We've covered debt. I think the replacement of the system to a more debt-driven system and all these kind of interventions and things like that have changed the dynamics of the markets quite a bit.
That makes sense. And just for everybody who's just needs a quick refresher on volatility, when they see a realized volatility of 46.3%, what does that actually mean?
It literally means the market has moved in a way that fluctuates by 46% in a year, which you know, we've seen what the drop was, I think close to 40% on its own, and a massive increase. You know, that's what it translates to.
So it's a 46% chance that it could go up or down, correct?
Based on the way it moves, yes.
Okay, cool.
All right.
You want to, any questions?
Yeah, any questions? Let me pause this. I've been talking too much.
It's all right. We like it, man. Nothing from Rob Ross. We got him quiet for once.
Well, I just don't want to jump on people. So when you're talking about realized volatility, you're talking about just like standard deviation, like over a year, basically.
Yeah, just the actual standard deviation of price movement.
Over a year.
Yeah.
Because I know right now the market, because the VIX is around 25 to 35, the market's moving like 2% a day on average. And just like 5-6 years ago, it was like we had very little 1% moves. So yeah, we're definitely in a much more volatile.
Well, if you're looking here, 2017 was it was the least volatile year since 1995. If you remember, we were stuck at a VIX of 8 or 9 the whole time until 2018 came in, and you had all the VIX ETFs blow up on February 5th, 2018. I remember. Yeah, sorry. I just remember that well because I made a lot of money that day.
I think it would be interesting to comment on the potential effect that the larger semantic trend of the flow of funds into passive vehicles and how that's increased to represent 60% of assets in the public markets.
Sorry, how do you know what I'm going to talk about next?
Literally, he has not been told what we were going to talk about, but he's got some forward vision here.
I mean, I just I think a lot about entropy, and I think it applies to markets too.
You're 100% correct. But we
will get there. You just hold tight, okay?
Yeah, we'll get there.
Yeah.
We'll get there. So we had this long talk about the Fed, money supply, and you've heard me hammer the Fed, and liquidity so many different times because I'm a believer that at the end of the day, it's liquidity that drives asset prices, not earnings. As we're seeing right now, earnings suck, but liquidity. There's plenty of liquidity, and we've seen the market rally from that trough. So this is an interesting slide that I don't know what it would necessarily hold into the future. On one hand, in the blue, you see the M2 money stock, which is basically just the amount of money that's available out there. And we can see what happened to money stock just recently with COVID. But that's in a 9-month lag versus CPI. So CPI right now took a big hit because COVID was initially deflationary and it went down back to 0%. And normally the M2 rate of change has been really correlated to that CPI with a 9-month lag. So I think it's going to be really interesting to see what this is going to mean for CPI, 6 to 9 months from now. And that there's some inflation risk when it comes to that.
Got it.
And talking about the money supply, this is the current Fed activity that I pulled out. This is 7:15 for those who want to look at it. On 7:15, the Fed is going to buy almost $13 billion worth of treasuries. They're telling you which one they're buying as well. And we're still seeing a lot of QE activity.
Okay. I was going to say no, but they've tapered this off a little bit. Continue.
They tapered it quite a bit because the market has probably been more stable. This is pure madness going on there of 125 billion going on every day, which obviously bottomed the market when it did in March. And they've tapered as the market has gone higher, but they've stayed at the same level for quite some time, more or less in the same level. So for those of you who still care or keep count about those kind of things, they've already issued $2.82 trillion in treasury securities and MBSs that have been purchased by the Fed in the open market. I believe we collect slightly over $3 trillion as far as tax revenue. And this is monetary policy, has absolutely nothing to do with the fiscal policy that the also was a $2 trillion spend. So just for those of you who keep track or care about little things like how much money the government is issuing, spending, and et cetera.
And I look at this graph, and this makes me remember that slogan: "Don't fight the Fed," because in one graph we're literally looking at $3 trillion. That's, what is that? Is that 12 zeros following the three?
Who keeps track of zeros?
Doesn't matter. Let's just
I
add.
can add in with
Who
you
cares?
guys. I don't know if you guys follow Anthony Scaramucci, but it's really interesting because the Treasury's been taking their money and leveraging it. So he thinks the Treasury is going to put in as much as $8 trillion from the money they got from Congress because they're borrowing against the $2 trillion that they got from the plans.
Right. So I was seeing that the Fed actually had a problem because they're spending $8 trillion, but so you're saying they're just going to leverage it.
It's the Treasury that's leveraging the $2 trillion that they got from all these programs. They're using debt against it up to 8 to 1 against every dollar. So they're doing huge leverage. So I think that's why the market, in my view, is taking off so much. Is you could have up to 10 to 12 trillion dollars coming in between the Federal Reserve and the Treasury.
That's insane. That's 4 to 5 times the normal budget.
Yeah, it's crazy.
Modern monetary theory, full implementation.
Yeah.
Awesome. Thanks for that, Brian.
Yeah, thank you, Brian.
So that's, following the kind of like the money situation. And what is this causing? Just like Tori mentioned, the issue with the Vanguard market. So you put your money into these Vanguard passive funds and, they all buy the same thing because they're buying what's liquid and what's available. And we have a situation right now where in 2020, almost 23% of the entire S&P 500 is Microsoft, Apple, Amazon, Google, and Facebook. And reminding you guys, in the peak of the dot-com bubble, we only got to 18%, where 5 stocks were just Microsoft, GE, Cisco, Intel, and Walmart. I guess Bill Gates did something really, really well and smart because in both of these occasions, he's still there.
That is true. Well, you're hitting on something super important here. When I talk to other wealth managers, they are worried about the exact same thing here, which is the fact that because the FANGs or the FAMEs, whatever you want to call them, have so much market share now, one of the issues is they're all worried about correlation of other assets. And when they're thinking about what to add into an asset mix, everything touches a Microsoft and Apple and Amazon to some level. So they're sitting here saying, how am I supposed to create an uncorrelated portfolio when everything has exposure to these big players?
And also, I didn't cover it today, but maybe if we have time, I will. If you just go on and look at the stock chart of the NASDAQ, you see it's at all-time highs. It's up 10% for the year. The S&P is a little bit down, maybe down 7% for the year. And if you look at the small caps and you look at other companies that don't get this Vanguard money, they're down even from 2 years ago. So this is, I think, the biggest disparity I've seen in markets where, if you wanted to do the real Warren Buffett style investing and buy those value stocks at a good price that have a good product and all this kind of stuff, you're going to be stuck at a value trap because they're never going to go up because nobody's going to ever allocate money to them because everybody's just allocating money to these mega caps. So, that's why value investing is kind of dead right now.
I know that Josh Brown, who's a money manager out in New York, mentioned that I think it was in 1965 or 66, during that boom, there was 5 or 6 stocks that represented somewhere in the high teens, probably like GE and General Motors and stuff like that back in the day. So it does happen on occasions.
Right. But I don't think we've ever seen it at 23% of the S&P 500. So I think that all these things that we're seeing, they're just adding to market fragility. So we're seeing that these kind of, the reinflation of the market with the Fed money hasn't necessarily reduced the risk of the market as it's gone up. It actually increased it.
And it increased because there's a higher concentration into a few, correct?
Yeah, correct.
Makes sense.
So talking about market cap increasing, This is my attempt at humor where Tesla is going to the moon via a SpaceX rocket.
There we go. Nice, nice 2020 for Elon. I guess that magic 3-letter word with Elon in the middle really has come to fruition.
So I think it's an interesting symptom of what's going on. Looking at Elon Musk's net worth, only in the past few months, he's made quite a bit of money.
It's almost almost 35 billion that he's added to his net worth just in 3 months' time for the other people that aren't actually looking at the screen right now.
Right, which I like the guy. I think he's pretty awesome. But this is pretty nuts. So let's talk about this a little bit. So here is, as of Friday, the 15 richest people in the world. Elon is now number 7. Jeff Bezos, almost worth 200 billion. Mark Zuckerberg worth 93 billion. And Mackenzie Bezos is the 13th richest person in the world.
So what's insane about this is if you would have just gone back a year ago, Gates is still number 1, and now Bezos has had a big divorce and is completely overtaking Gates by a long shot.
Right, by a long shot. And what's crazy is the super fast increase of Elon Musk. He's now worth the same as the Google guys. So, what's explaining this? I just wanted to look at Tesla versus the mega caps. So I'm not even comparing Tesla to an automaker because it's worth more than any other automaker anyways. So there's no point in even comparing it to an automaker because the market doesn't see it as an automaker anymore. I don't even know what the market sees of that. And I've compared it to Bank of America, 210 billion market cap, Tesla 317, much bigger than Bank of America. Intel 255 billion, Tesla 317 billion, bigger than Intel, bigger than Netflix, bigger than Home Depot, bigger than Walt Disney, and almost the same size as Walmart.
Unbelievable.
And this is for a company that doesn't even have a clear path for profitability.
Okay, so how the heck does something like this, how does this happen? They're a great company, but this is absolutely batshit crazy.
Right, and I don't believe there was a material change in the company's news or anything like that to have triggered this, right? We didn't hear that all of a sudden they're, doing so much more or better or whatever it is. And I think there's a couple of reasons why we're seeing this kind of movement. So first of all, let's look at the short interest. So just very plainly, when you're betting against a stock, the way you do it is you borrow a stock you don't own, and then you just sell it at the market outright. And as you do that, you're hoping for the stock price to fall and for you to be able to buy back cheaper. And then you return your borrow share, you pocket the difference. Fairly simple and has been done since the beginning of time. So a lot of people say, well, you know what? The short interest in Tesla has not been as high as it was. It used to be 40 million shares and it's gone down significantly and it hit new cycle lows. But I look at short interest a little bit differently. I look at it as just the dollar amount because it is much easier to short 40 million shares when the stock's only at $200, much more difficult to do that when the stock's at $1,000. So if you look at the dollar volume of short interest, that's much more correlated to the stock price. So who's shorting the stock? The smart hedge fund guys like David Einhorn. He sees this market cap and says, this is ridiculous. The stock has no business being where it is. And, he had some famous fights going back and forth with Elon Musk. And in the past, the shorts were more or less right about Tesla. Last time up when Tesla reached the $900 level, they've accumulated $15 billion of short. The stock went down all the way to 400. They've covered, they've taken profits. As the stock went up again, they've ramped up the shorts again. But this time, they're completely wrong and getting totally wiped out. And when you get a short squeeze, what happens is there's literally, you get a margin call. It's an upside crash. They're telling you have to liquidate your position. You're trying to buy it, but there's literally no stock available. And it just creates this upside squeeze that just crushes those shorts and forced liquidation all the way up. And I think we're seeing a lot of that happening in Tesla as a major issue why it's gone up so much. And why has this happened this time around? is because this time there's a new factor, and it's called Robinhood, which here you can see in the light green here, the positions of Robinhood players in the stock. So you can literally see how as we've gone up, the amount of Robinhood holders has exploded. And this is a real Robinhood because they're taking it out of hedge fund managers that are losing their ass as the stock is going up and they've shorted it.
Got it. So let's actually talk about this for a little bit. So you're sitting around here saying this is a classic short squeeze. I've gone ahead and posted a graph too of what happened to Volkswagen. I think it was back in 2008 where the exact same thing happened. So we've seen this dance before. So for all the people who are saying it's new technology, all of this, you're calling bull on that, and you're saying this is a traditional short squeeze.
I think so. I mean, at the end of the day, you know, Tesla is great and I love the product, but does it need to be at a market cap of Walmart? I mean, I don't see any reason for that.
So if I'm sitting here agreeing with you and saying great company, incredible entrepreneur, totally out of line with market, I want to short, what would you be doing if you were me and you wanted to short?
Well, first of all, make sure you have a change of underwear.
Okay. I've got a few. I did laundry yesterday.
And I would tell you it would probably be something that's very, very risky to short. And I think the borrowing rates for shorting the stock may be really high as well. So, you know, what you have to do is you would have to use some kind of options in order to express that position. That would be the only way I would reasonably do that in a defined risk way. So I know how much money could be lost if you're completely wrong on it. And remember also what John Maynard Keynes said, which the markets can stay irrational longer than you can stay solvent.
So that goes to a great point. Larry was mentioning that, you know, this could go on for a long time. Larry, you've seen these patterns for quite a while. How long can these things continue to go up for?
Until they don't. And I don't mean that as a joke. You know, I mean, I've seen it many times. I think back in 2000, 99 through 2001 with the .com, I lost a lot of money just buying puts and buying puts and buying puts. And yeah, to your point, I didn't have the capital. It went on for 2 more years. And it just got, you had the same thing with the bonds, after 08, where everybody knew they were going to go down. Now, the play there, if you really want to do it, probably would be some type of a put spread, because, you've got huge skew to the downside in the puts. So your put spreads actually end up being pretty cheap. Of course, you're also not going to, by definition of this spread, you're not going to capture the huge move down if it does crash. But then again, something like Tesla, maybe it's a little bit of everything. Maybe there is some technology coming. Maybe it is worth more than people think, but not at this kind of acceleration. At some point, you hit an equilibrium. You hit a level where it has to go back down to equilibrium. So put spreads is a way to do it. You can roll put spreads. I don't know if that answers the question. The answer is there's no way. There's no way of knowing how long it lasts. It lasts till it doesn't.
All right, wise words. You've seen it happen a bunch of times. I appreciate that.
Bunch of times. And by the way, I made a couple. I don't think that this is this similar. It is. It's a classic short squeeze. And Jeremy, I mentioned to you earlier in a comment about when we were talking about VIX and implied volatility, which really was also a short squeeze. I mean, there's no doubt it had the underlying volatility. So volatility should have been much higher. But Ite, to your point, it never, implied volatility got so much higher than historical and actual volatility. And that was just a function, in my opinion, of short premium sellers blowing up and needing to cover, and then the clearing firms needing to cover, and there wasn't an offer to be had. So, so again, short squeezes always look huge like this.
That's exactly what it was.
Larry's been through 4 100-year events.
Yeah, yeah, Rob, you've been reading well.
And Rob, I know you had some comments about Tesla as well.
Well, there's an article today about Tesla being put in the S&P 500, and it's just a little bit of area that I'm actually writing a book on, where I have a list of candidates. I won't go into the theory, but in order to get into the S&P, you have to have year-over-year positive earnings, and so those earnings are for Tesla, I think, come out the 23rd of July, and even if it's flat, they have now 4 quarters of earnings, and year-over-year they would be positive. They'd have the market cap. And basically, and so the price of it's gone up because a lot of people think it's about to get included into the S&P 500. And then all the Goldman Sachs, hedge funds, pensions, institutions then have to buy it in mutual funds because they got to mimic what's in the S&P 500. So it's up on that kind of speculation. The issue is that I just wanted to point out is, yeah, it qualifies. So then it goes on the candidate list. Well, they have a Dow Jones, S&P manage over 1 million indexes. And so they meet. And so usually like on the S&P, they have a once a month meeting to say, okay, what stocks are in the queue? And then you have to wait for a stock to drop out due to mergers, acquisitions, bankruptcies. And then they take from the queue. And usually they look at the 11 different sectors like consumer discretionary, industrials and all that, and see where the S&P index is kind of underweighted compared to the overall market of large caps, and then they kind of take from that list. So it's not going to, I really doubt if they have good earnings on the 23rd that they're going to go in the S&P index this month. It's possible in August, but I don't think it's going to happen this month.
Well, you may have potentially given us a day of the top, because if that's happening on the 23rd, even if they get included, it's buy the rumor, sell the news kind of thing. It's very common.
Well, and generally speaking, you get a 3 to 8% pop upon the announcement. And then the day of inclusion, sometimes there's a big volume rush. And then after that, then you have some deflationary stuff. And there's been a lot of people that have tried to do their master's theses on having a stock portfolio of stocks that got included, but they're too late to the show. And those stocks actually underperform the market their first year. So yeah, we're coming to, if it gets included, we are coming to a big rush, and then at the top, and that would be your opportunity then to do some kind of a strategy like Larry's talking about of maybe a call credit spread or something like that. Once it goes into the index that day, that morning, when you see the volume, and the volume will spike 2 to 10 times what it normally is when it gets included.
So you just gave me a strategy idea. If that's the case, you short the stock that gets included, and you buy the index, and you get the spread in between.
Yeah, you'll have to read my second volume of my book to get all that.
We're just waiting for volume 1, man. Get off the call.
It's done. It's done. It's just I just did the first printing, and then we're doing a few corrections. Then the second print will come. I'll be on Amazon. I'll let you guys know.
I'd love to read it.
Great. Well, we can't wait for it, man. Thank you.
All right. Any questions for anything? Because I know the other stuff is already options, and I don't think we're going to have time to cover all that. So we'll probably stop it there. Unless we want to talk about some more stuff.
Well, let's see about questions first, real quick. Okay. Well, I mean, given that it has been an hour, Itai, maybe it's better to just go into general Q&A about anything related to the market and not just related to Tesla. What do you think about that? Yeah,
anything about anything from the slide today.
I'll bring up something here. You had mentioned, we were talking about the 23%, the 5 mega companies, 23%. There's been a lot of talk over the past few years about the FTC, DOJ, forcing these companies to break up, that they are just too big, that they're controlling and monopolistic, kind of going back to the AT&T days, which, that didn't really work out so well, but in theory, I get it. When you get these companies that are as big as nations, it really doesn't make sense to have that much power, and I'm not a government guy, but I get it. So what do you think the chances are of them getting involved in antitrust activity? And also, what kind of effect would that have on the markets?
I have no idea what the chances are that it's going to happen, but I think the market may react negatively to it, right? Because there's such a large market cap. I can see how the market will see that as a risk, just because, if it splits up into a few companies, will the Vanguard buy it or not? And there's so much liquidity concentrated in those stocks. But as a market person, I do think that it's not a terrible idea to break those companies up. I mean, look what happened to going all the way back to Standard Oil, right? When they broke those with the Sherman antitrust, I think.
Yeah.
I mean, that was then ended up being a net positive for competition in the economy, right? And we're seeing a lot of that. I don't understand why in 2008 they didn't break up the big banks and turn them into 10 different JP Morgans and more competitive. And I think that was a huge missed opportunity.
Well, they doubled down in the wrong direction there. They actually consolidated further.
Yeah, well, Glass-Steagall totally opened it up in terms of allowing them to have cross-border, right? Back in the day, I mean, I remember back in the, 80s, 70s, 80s, the reason all the big banks were in Japan was because of and that's what caused it, Jeremy, that they wanted to compete with the Japanese banks. What the U.S. banks, I don't know if you guys remember that they literally were chartered that you could only operate in the county you were chartered in and the adjacent counties, the ones that actually touched it. So you didn't have any banks that were, let alone global or national. You didn't even have statewide banks. Everything was much smaller. So they went in the opposite direction, really. JP Morgan had their investment bank side, but not their retail banking. That was all just really at the time in New York City.
Right. And consolidating the banks too much is risky.
Yeah.
And a quick question: do you remember? I'm not sure you guys will have the answer, but under what type of administrations has there historically been antitrust regulation? So was it Democratic, Republican offices that made that happen?
It's a good question. I mean, my analytically, I'd say probably the more conservative leadership would have more Well, I don't know. I don't know if there is a pattern. There really hasn't been that much major antitrust activity over time.
There really hasn't.
Really, Microsoft under the Clinton administration was a huge, of our lifetimes, big antitrust case.
Well, AT&T I'm a little older. AT&T was probably the biggest, but I don't even know when that was. 70s? No, later.
Well,
early 80s.
One of the things about the Microsoft thing is they had no presence in Washington, D.C. And so then what happened with that antitrust stuff is because Utah Senator Orrin Hatch represented, of course, Utah. That's where Borland Software was, and Borland was raising hell and giving them a lot of money. So then that's what through the Microsoft thing. Well, then Google, when they started getting bigger, they went and got a bunch of lobbyists, and all these companies now pay K Street lobbyists because that was Microsoft's big mistake through the 90s is they didn't think they needed to have a Washington, D.C. presence. And the other big ones learned from Microsoft's, unfortunately, it's quote a mistake that they had to have this huge lobbyist presence in Washington, D.C. And that's why, you're just now starting to hear kind of inklings of it, but not beating the drum like it was back in the 90s when one senator could basically get the whole thing started.
Yeah, I think there's a lot of challenges to implementing it these days. I think first of all, lobbyists are a huge obstacle in the government taking these actions. But the other thing is the globalization and the technology itself, the stuff that they've actually created. It's tough when they can pick up and go domicile somewhere else, and it's tough. I'm not sure how you can control. Once the cat's out of the bag, I don't know how you control it sometimes.
Got it.
It's Thank like you. too big to control, too big to regulate almost.
Yeah, and too big to fail is expanded beyond the banking industry.
Yeah.
Cool. What other questions do we have just in general markets from everybody else out there?
Based on all the charts you ran tonight, Itai, so what's the market going to do through these earnings announcements?
That's tough. Today was an interesting day. That seems to be kind of a trend reversing day. Guess we'll see tomorrow if there's follow through.
When you say, I think the one thing we could predict is just going to get a lot more volatile.
Well, there's two ways to look at it. You could also argue that in the past maybe couple months, volatility has been underpriced. I mean overpriced, because the VIX is still hanging out closer to 30 and the market has been stabilized. So I think one of two things is going to happen. We either start a much more volatile trend going forward into the summer, into even the end of the year, and we're gonna end up lower around here. Who knows? The other thing that could happen, I think, is equally as likely, is the market will actually have an upside break and volatility would go back to 15 on the VIX, 15 to 20 range. And right now I think it's kind of in the middle. And I think that upside risk is also pretty high and very, very discounted. Most people I've talked to actually have a bearish tilt and they think we're going to see downside, more volatility, etc. I think the upside risk is present and not too many are talking about it.
Do we still know how much capital is on the sidelines waiting to enter?
Yeah, quite a bit.
I say quite a bit. Can you like quantify how much?
Let me get you the exact number. Hold on one sec.
Okay, got it. So it's kind of interesting right now because even though this capital's on the sidelines, the rise of Robinhood might be one of those things that's pushing the market up. And if this capital decides to enter, that's when you could have that big upside break, right?
Yeah, absolutely. You have so much capital that could potentially get in. So I'm still looking. Hold on.
Yeah, and I think that's one of the things that me and Itai just in our when we kind of think about this for our own personal investing purposes, we see this, all this money that could potentially flood the system and what that's going to do to returns. And so we kind of look at it and we personally at least think, all right, well, the returns on equity going forward, they may not be so fantastic. So maybe it behooves us to search for alternative areas to toss in money. So one of the core things that we try to do is we try to find alternative investments. So for any of you who weren't on the last call, we really dug deep into multifamily investing last week. And that's at least the world where, we've been able to find some outsized returns. And we're now evaluating, we spend a lot more of our time nowadays evaluating some of these alternative classes outside of equities, just because, the writing's on the wall for there to be paying very heavy, very heavy premiums to get earnings within the markets that maybe traditionally you didn't have to have.
By the way, I'm seeing 18 trillion.
So 18 trillion. Okay. So this is held in the hands of the big corporations, the banks, et cetera, who could flood the system with more liquidity if they needed to.
Yeah. I mean, this is money that will eventually need to get a return. And I mean, one of the reasons they set interest rates at zero is not only that, people will be able to lend for cheaper and et cetera, is a big portion of it is actually to force those people to invest and put money in markets, real estate and all that, and just flood the system with liquidity. That's also one of the things they want them to do, because if you can't get returns on your money in a savings account, a lot of those big corporations were totally fine getting a 2% clip, a year ago when rates were a little bit higher, and now they potentially may be forced in investing in riskier assets.
So Ite, when you say 18 trillion, what is that in perspective? Like what's the range of that typically?
That's a lot higher than normal. COVID had a big increase, and also the liquidity injections from the Fed and all that ended up going to people that didn't need. A lot of it ended up in the hands of people that don't necessarily need it. So I think it's like 5 or 6 trillion more than the normal.
What do you guys think about COVID? I mean, I think if there's going to be an upside surprise, it's something around COVID, a vaccine or some type of treatment. All of a sudden, if you take that off the table, the markets probably skyrocket.
Yeah, given the amount of money that's out there, I mean, I think a lot of money is waiting for some kind of news about that to just get in. And I saw there's a list of like 20 potential vaccine, and there's like 50 or 60 different types of cures. I don't know. I mean, I think this year we're probably not going to see a vaccine, right? It's not feasible, but there's already a few vaccines that have been fast-tracked, right? I mean, realistically, we're probably going to see a vaccine within a year.
Got it. And then let's just say the vaccine comes out. How long do you think it's going to take to ramp up and be able to get enough and actually build the inventory of the vaccines to distribute on a mass scale?
Maybe another 6 months.
Okay. So between 12 to 18 months, something monster could happen in these markets.
Well, I think the market's going to know that a vaccine is coming much before it's announced.